AMD shares are higher after beating analyst expectations for profit and revenue in the first quarter. Analysts, though, digesting a mixed outlook here. The company expects a $1.5 billion hit to revenue this year due to U.S. restrictions on chip sales to China. The company also sees a headwind to gross margins here. And despite some of the hype around AI, AMD shares are actually down more than 30% over the past 52 weeks, the past year here. The company somewhat plagued by the hype with revenue lagging expectations and a sluggish PC market. So what should you do with the stock? That's the big question. Joining us now, we've got Stacy Rasgon, Bernstein Managing Director and Senior Analyst. You've got a market perform on this. Just walk us into your read on the earnings and what the company is essentially telling Wall Street about its own business within this broader kind of AI drive that we've seen.
Yeah, you bet. So the earnings themselves were actually not bad on the surface at all. It was a pretty solid beat and raise. The issue and the reason I think the stock is not doing better this morning is just the beat was entirely from client and gaming, which were massive, client particular PCs, which were massively above expectations. And I think investors are hesitant to buy that. There are really real concerns around possible like pre-buying and pull forward and inventory build in front of that. Their competitor Intel had actually talked about that risk, material risk potentially. So if you look at the pieces that people do care about, data center in particular, data center was kind of in line, and actually the data center GPU, the AI GPUs that people really care about in the quarter, I think actually missed expectations. On the guide, that stuff was weak. They have those China headwinds that you talked about given the China ban. They guided data center quite weak. I think though, even if you accounted for the China headwinds, the data center GPUs on the guide were just in line. Again, the overall guidance was well above the street, but again, it was all PCs and gaming. I just think people are hesitant. They don't really want to pay for that. And the data center piece itself is not really showing upside. On top of that, OpEx spending is going up, which is kind of limiting your EPS outlook. And then if you look at their overall kind of like general outlook for the AI business, you need a hockey stick at the end of the year. It's actually very similar to what happened last quarter. Was almost like a carbon copy in terms of those trends. And I think that's why the stock is not doing better today, even though like on the surface, the numbers actually, even in the wake of those China headwinds, were quite good.
Should investors bank on that hockey stick on the back half of this year?
You never know, right? I'm always a little hesitant to bank on hockey sticks. And my general view for semi companies in general, like I'm not AMD, but just in general, is that their actual visibility into what's really going on with demand is usually pretty low. What they see are the orders in front of their face. They probably have orders and they've got some trajectory, that's in the plan right now. We won't really know what we're going to see at the end of the year until we get to the end of the year, so we won't know. And so I think right now investors are going to be a little more hesitant to bank on that.
All of this market seems to be laser focused on the opportunity in China. And of course, why not? Because, second largest economy by GDP, you want to make sure that there's also kind of longer standing relationships, continuing recurring orders that come forward there and building out a solid book that you can service. But where else are there opportunities, even outside of China, that the AMDs, the NVIDIAs, all of these semiconductor spaces are clearly trying to identify the next region and the next country that they're going to be able to sell into and kind of deepen and entrench themselves with?
Well, they sell everywhere, right? Semiconductors are very global. And that's the risk with all of the geopolitics and tariffs and export controls. China's a big market. They're probably responsible for 20%, maybe more, of semiconductor consumption. And in terms of shipments into China, it's quite a bit higher than that because a lot of the electronics, at least at this point, get assembled there. So these are big markets to decouple from. I think on AI, we're seeing like the biggest like near-term risk. The companies like AMD and NVIDIA were just banned from selling their AI parts into China. And to my mind, it's sort of counterproductive because China actually does have local parts to serve that. They're not as good, and you don't have the ecosystem. This is Huawei mostly, but if you completely cut them off from U.S. options, they're going to go more and more toward that. My view has been we've just handed, if nothing changes, we've just sort of handed the China AI market over to Huawei. I don't know why that was the right thing to do, especially when we have like U.S. products that can sell there and they have local products that are competitive anyways. Like why make it easier for them if it's going to happen anyways?
Just lastly, Stacy, just lastly while we have you here, we've heard about these major investments from the semiconductor names about how they're going to leverage more U.S. resources or invest in America, essentially, to build out more of their capacity. Is that something that you anticipate to come forward and I guess in a high magnitude that would eventually pass through their bottom line, or is that going to be more costly for these companies?
Well, it is happening, right? I mean, so it's like TSMC, for example, is building out a tremendous amount of capacity in Arizona. So they were already going to invest, I think it was 65 billion, and then now after Trump, it's an incremental 100 billion supposedly on top of that. So over the next, I don't know, 5 years or whatever it is, it's a big number. And we'll see what happens with tariffs directly on semis and everything else. But clearly, the Trump administration is trying to incentivize more local production of things like semiconductors, which I think is a good thing. I think we need that. Yes, will it be more costly? Yeah, it probably will be more costly. And somebody ultimately is going to have to pay for that. You know, in a good world, that somebody will be the end customer. And in reality, those costs will probably have to get shared to some extent across the supply chain. So costs will probably go. But with tariffs and everything else, even if they're not just on semis, tariffs on the end products that semis go into, I mean, costs are probably going to have to go up anyways. I mean, I don't think there's any way around that right now.